Let's talk about the most stressful click in investing, the sell button. Deciding when to let go of a stock can be completely paralyzing. You stare at the screen and the internal debate starts. Do you lock in that tiny profit before it vanishes? Or do you finally cut your losses on a stock that's been bleeding for 2 years and quietly delete all those text messages where you told your friends it was a sure thing? The reason this decision feels so agonizing is that almost all of us start with the exact same piece of bad math. We base our entire decision on the price we originally paid. We look at a chart showing where we bought in, watch a sudden 30% drop, and then stare at a multi-year flatline. We trap ourselves in a loop, asking, do I sell and lock in this painful loss, or do I hold and hope it eventually recovers to what I paid? But by fixating on that original buy-in price, you aren't managing your money. You're just managing an emotional scorecard of past decisions, instead of strategically allocating your capital for tomorrow. Warren Buffett has a very simple, slightly blunt reality check for this exact problem. The stock has absolutely no idea that you own it. It does not care what you paid. Imagine two people looking at the exact same stock trading at $50 a share today. One investor bought in at $100 and feels like a massive failure. The other bought at $10 and feels like a financial genius. But their feelings don't matter to the business. They hold the exact same asset, with the exact same balance sheet, facing the exact same future. So if your original purchase price is useless for deciding when to sell, what should you use? We are going to strip the emotion out of this process and look at the 3 objective, forward-looking triggers Buffett actually uses to justify selling a stock. Because selling shouldn't be an apology for a past mistake. It has to be a calculated move based on current reality. The first condition where selling makes perfect mathematical sense is simply this: you have found a clearly better option. Sometimes you sell a perfectly healthy business just to fund a superior one. This comes down to opportunity cost. $10,000 sitting in a stagnant, mildly profitable stock cannot simultaneously be deployed into a rapidly growing business. Your money can only be in one place at a time. In 1959, Buffett actually held shares in Commonwealth Trust that were heavily undervalued and likely to grow, but he sold them anyway, taking the cash to buy an even better deal he found in the Sanborn Map Company. Look at this strict comparison. On the left is your current holding. On the right, the new opportunity. Jumping isn't free. You must subtract penalties for taxes and fees. A new investment must be vastly superior to clear this hurdle and leave you wealthier. Loyalty to a ticker symbol is a financial liability. You only hold a stock if that specific asset remains the absolute hardest working place for your capital. The second trigger for selling is the lost moat rule. You hit the sell button when the underlying economics of a business irreversibly break down. Notice the distinction here: a bad earnings quarter, a supply chain hiccup, or a scary headline. Those are temporary setbacks. A lost competitive advantage is permanent. Plot negative news on 2 axes: temporary versus permanent, and low versus high impact. Bad earnings sit in the low impact temporary zone. Losing a core advantage plots in the high impact permanent quadrant. This upper right zone is the sole justification for a sell-off. We saw this in real time in 2020. Berkshire Hathaway held massive stakes in U.S. airlines. Then global travel halted. Planes sat idle on runways. The economic reality collapsed, and Buffett liquidated the positions. He did the same thing with the Washington Post. For decades, a physical printing press meant an absolute monopoly on local advertising. Then the internet arrived, advertising moved online, and that local distribution monopoly vanished. The moat was gone, so Buffett eventually sold. Admitting your initial thesis is broken is difficult, especially if it means taking a steep loss. But taking that loss is strictly necessary to protect your remaining capital from bleeding all the way to zero. The third trigger is a problem most investors hope to have: the success penalty. This happens when one of your investments performs exceptionally well. Warren Buffett is famous for ignoring standard diversification advice. He likes heavily concentrated portfolios rather than owning hundreds of random stocks. But even he recognizes a breaking point. Back in the 1960s, he made an enormous bet on American Express. It went incredibly well, so well that it ballooned to roughly 40% of his partnership's total assets. 4 out of every $10 was in one company. That level of extreme concentration introduces single point of failure risk. If you let a winner expand aggressively until it consumes almost half your pie chart, it visually crowds out the rest of your portfolio and destabilizes everything you've built. Now, you face a distinct trade-off. Trimming that winner means paying capital gains taxes and giving up future upside. But if you don't trim, your entire financial survival hinges on a single CEO having a flawless decade. Selling portions of a massive winner isn't an act of doubting the company. It is a necessary act of defending your overall portfolio's viability. So, how do you apply this to your own brokerage account today? You can synthesize this entire philosophy into one diagnostic question designed to instantly break your emotional attachment. Ask yourself right now, if you didn't already own this stock, would you invest fresh money into this company today at its current price? If the answer is yes, and you still believe the current valuation makes sense, then your next move is simple. Doing absolutely nothing is perhaps the most underrated and active strategy in investing. But if the answer is no, you have to run it through Buffett's 3 triggers. Have you found a mathematically better opportunity? Is your original thesis broken? Or has the position grown dangerously large? If any of those conditions are met, the math tells you to sell. If a stock fails this flowchart test, holding on to it purely out of stubbornness or a desire to avoid recognizing a loss means your capital is dead. It needs to be reallocated. For newer investors, recognize that refusing to sell just because you don't want to look at a red negative number in your app practically guarantees long-term underperformance. For the diamond hands crowd, remember that the hold forever mantra only applies to structurally sound, growing businesses. Loyalty to a dying economic model is not a virtue, it's just bad math. And for the optimizers, make sure you carefully calculate the friction of taxes and trading fees against the compounding potential of any new opportunity before you make the leap. A great investor never looks backward at their receipt. They only look forward at the opportunity.